Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into the financials and tell you about the key risks and triggers going forward. Let's not waste any time and get to our first stock today. My colleague Nigel traveled to Kolkata and gets us this very special deep dive on Eveready.
Well, Inside Out on the Road has traveled to the city of joy. We're in Kolkata at the headquarters of Eveready Industries. Remember, the stock market is a little bit more optimistic on the prospects of Eveready 2.0, so to call it. That's post the Burman's takeover and after many years of not growing at all. Well, on the shareholding pattern, the promoter entity holds roughly around 43% stake in the company, and out of that, the erstwhile promoter holds only around 4.5% stake. The new promoter, that's the Burmans, well, they hold bulk of that. In notable mutual funds, Tata Mutual Fund, they have close to around 2% stake in the company. Now, on the financials, in the last year, they delivered 1,300 crores of revenues with margins of around 8%. Further breaking it down into the segment-wise, well, you have the battery segment, you have the flashlight segment, as well as the lighting business. The revenue comes up for you on the screen with their margin profile as well. A quick word on each segment. The battery segment, they are the market leaders with more than 50% of the market share. On the flashlight segment, well, they have a strong presence in the battery-operated flashlights. While on the lighting business, they're still a relatively small player, but there's tremendous potential for growth from here on. Well, the new management, they are focusing on revenues in mid-teens. Therefore, also looking at a push strategy rather than a pull strategy. That's what they're looking at. And also their focus has been on premiumization. For that, they'll have to spend more. So higher advertising as well as promotion costs. And also they're guiding for steady improvement in margins. Well, their debt is at around 360 crores and they're borrowing at around 9% margins. Well, there are some risks as well because the dry cell battery, well, the market itself isn't growing. They have low presence in the rechargeable flashlight segment, and they're yet to make their presence in the lighting segment. Well, also they're guiding for a push strategy, which will demand higher amount of advertising and promotion cost. Will it come at the cost of margins? Well, those are the risks. But to understand more about the company, let's get straight and get chatting with Mr. Saha, who's standing by. Thank you so much for having us. Thank you. Now, the stock markets are excited about Eveready 2.0. With you at the helm, could you tell us what are the 3 or 4 important points that you've set out with regard to a strategy for Eveready 2.0?
Okay, but before everything, Nigel, heartiest welcome to our office.
Pleasure.
We come here every morning with a sense of joy. And that is our city is all about, city of joy. And I hope that during the course of this conversation, I can share some part of that joy with you.
Absolutely. Your shareholders are waiting by for some kind of joy because otherwise, Eveready has always had plenty of potential. But that's not been unleashed. So, Eveready 2.0, what have you listed out as your goal?
First of all, I wouldn't put a numeral to the version of Eveready.
Okay.
I would like to call it Eveready Infinite. Okay. But, in real sense, without going into semantics, I would say that let me put it in 2 time buckets. One is the medium to immediate to medium term, and the other the long term.
Right.
Medium term I would define as 3 to 4 years. We are good to go to a 2x from our current scale during the medium term.
See, when you double these revenues in the next 4 years or so, what should the contribution look like? Batteries, today is bulk of it. You have flashlights as well as lights. So, at doubling these revenues, how does the contribution change?
As we grow to a 2x level, battery would perhaps come down to a 50% level and the other 50% being shared between the two, of which 30 to 32% would be lighting and 18% would be flashlights. Battery would still continue to grow, but it is a mature category.
Right.
It would grow maybe around 7 to 8%. It won't grow but the other 2 categories, lighting and flashlights, they would need to grow beyond 25% to fuel the growth that I have just now mentioned.
In the carbon zinc batteries, well, you're the leader out there. You have more than 50% of the market share and you have held on to that. Could you tell us how do you see market share shaping up? In both the categories, that is carbon zinc as well as alkaline.
First of all, let me get to the market. The market is today 90% carbon zinc, 10% Duracell.
Right.
We are 54% of the total market. which comprises of all 100 batteries that are sold.
Yes.
We are over-indexed in the carbon zinc side, where we hold more than 60%, and we are under-indexed in the alkaline part. As we grow, we would certainly like to leverage the under-indexed part of our business.
Yes.
And we would naturally like to sustain where we are already strong. If we can do better in our under-indexed areas, then we hold on to our market share, if not improve upon it.
Got it. Mr. Saha, as a user, I'm aware that alkaline batteries are double the cost of a carbon zinc battery. But if you could tell me, profitability, how does it shape up as of now?
Okay, so at this point of time, we make much more money in the carbon zinc category.
Okay.
That is really, as you said, that is the cash cow.
Yes.
Now, the thing is that alkaline batteries are typically about 3 to 4x.
Right.
In our country, as players have been trying to, bring alkaline into the market, they have found it a little difficult.
Yes.
To do that 3 to 4x, people have tried but have not been successful.
Right.
So they have come to a 2x level. So this is, I would say, the initial phase of alkaline. The reason why people are not being able to implement that 3x to 4x is because in our country we do not have the devices that need alkaline. We do not have sufficient number of. You must appreciate that batteries is derived from the device population that exists in our country.
Right.
Just to give you a sense, in our country the largest consuming device is remote control. That takes about 40% of all batteries that is consumed.
Yes.
To give you a parallel example of a developed economy, that drops down to something like 3 to 5%.
Okay.
Which would tell you that there are so many other household devices taking batteries, and they are actually the hydrogen devices where alkaline has the best fit.
Right.
Like for example, I'll give you, toys are very small in India. I mean, we really need to grow in toys too.
So I've got 2 little babies at home, so I know how it is.
So you would know about it.
Where do you see then your market share headed in the alkaline business?
So
does it go to double digits in the next few years?
Oh, certainly the double digit would happen in quick time.
Right.
But I would say that the aspiration for the company should be to be balanced to the overall market share position that it enjoys in the battery market.
That would be music to the ears of your shareholders, but that would be a focal point. And just to get this number out of the way, alkaline, in the alkaline market share, you're in the mid-single digits as of now?
We are about 7-8%.
7-8%, and you're definitely going to be going to double digits is what it's the target.
That should happen in quick time.
Well, Mr. Saha, it's good to know you're focused on doubling the revenues. But a couple of questions here. One, what kind of capex do you have to spend to double the revenues with your current gross block? What kind of peak revenues can you hit? And point number 2 is, you've been focusing on advertising and promotion. That's something that's not been done in the past. So how do you see the margin trajectory ramp up from here on? What should be the near-term and the mid-term guidance that we're looking at on margins?
Okay. So let me answer the capacity part of it. The gross block that we have is capable of delivering this double the turnover kind of move that we have taken. If at all we consider, apart from routine capex, which is normal for any business, if we were to consider any fresh capex, that would be only in terms of improving our efficiency or profitability. It is not with a view to address capacity.
Got it.
Okay. Now come to the margin part of it.
Right.
As you know, we hold quite a large market share in the battery segment, and the question of margin erosion, that just doesn't even appear in our mindset. So going forward, as we address our under-indexed areas in the batteries, we only see margin improvement from here. Okay. We are also helped by, last year was a bit of a outlier. The unprecedented raw material inflation sort of resulted in drop in margins. Not only for us, I think the entire broader economy for that matter. That has cooled down and cooled off, and so as I said, aided by a stable raw material price position.
Yes.
We only see battery margins going up.
Okay.
As we go forward.
Right.
With regard to flashlights, again, we are a market leader.
Okay.
Okay, we are under indexed, which I would explain to you at a later point in this conversation. We are under indexed again in some part of the business, but we are still the market leader. The question, we sort of, set the rules of pricing.
Right.
So there is no question of any erosion there also.
And lights?
In the lights, yes, we are the follower.
Yeah.
We have a very small market share.
Yes.
So we are trying to see, first it has come in terms of getting our distribution right. Now it is, enhancing our portfolio.
Right.
But we still have to follow the leaders. We are, as I say, the small market shareholder. But as we gain scale, so today we are breaking even.
Right.
As we gain scale, which we aspire to do, that position would also become, it would start, it may not have the same percentage of margin as a battery or a flashlight, but it would contribute to the overall kitty of the company in the margin side.
And I think on the lighting segment, the margins you're guiding for from flattish margins to mid-single digits.
I would say mid-single digit for the moment, and if not, aspire for, let us say, a double digit sometime down the road.
Okay, so just to get this out of the way, in the near term, that's FY24, FY25, we'll be looking at mid-teen to 15 to 20% top-line growth.
I would say, Nigel, I'm sorry to interrupt you. I would say that our primary objective is, first of all, to exceed the growth that we clocked in last year, which was 14%.
Right.
Then we take a deep breath.
So better than 14% is what you're going to grow on this base of closer around 1,300 crores.
Yeah.
And margins in the near term, give and take everything that you're doing, reduction of cost, saving of cost, raw material costs going down, and spending more on advertising and promotion, double-digit margins at least, low double-digit margins are you looking at? Could you give us a band?
Immediately, I would say between 10 and 12% is what one would look at.
Okay, let's focus on a couple of other areas then. The arbitration case with KKR, which involves the erstwhile promoter as well, that's, that battle is still to be won. When do you see this getting resolved?
So as you know, Nigel, Eveready was not part of the KKR arrangement with the
promoter. Yeah.
So we have just been sort of dragged into this. We were not a part of the signing of the facility agreement and all that. And we really believe that we should not be playing any role at all in this. However, it is going through a legal process. It is currently going through arbitration, which the date line says sometime around early next year. Only, if there are slippages in there, it is not in our control. We would fight this valiantly, and that is what we have been doing.
But there's no risk to the existing business?
No. So the business currently has no risk because it has no impact on our current operations.
Got it.
Where it would impact is in the long term, because that particular embargo that we have on us is restricting us from raising capital and sell any non-core asset if we were to have any.
Right.
So, in other words, apart from debt, we have no money-raising avenue, which is, you cannot do everything through debt.
So if this arbitration gets resolved, the Burmans, do they intend to go ahead and infuse fresh capital into the business? Because they can't do it now because of the arbitration case. But post that, have they hinted that yes, they want to go in there and take a bigger bite of this business?
So I would just share some perspective which I've come to understand, and much of it is in the public domain, so it is not some opinion that I am giving. We all know of the success the Burmans have had in the FMCG space.
Yes.
What I understand is they are trying to build a bouquet of brand and distribution in addition to what they have already got. In that, their interactions with us indicates to us that they are extremely encouraging of our journey forward. The growth that we articulated a little while back has their full support and encouragement.
Yes.
And so, when the time comes, if KKR gets, resolved in a favorable way, one would assume that, that is how they have behaved. I can only go by their past behavior, how they have looked at companies.
Are there any synergies between both these two businesses, Dabur as well as Eveready?
So both are in the FMCG space.
Yes.
Dabur is, of course, way beyond Eveready at this point of time, so they are the big brother.
Yes.
There is no operating synergy per se, but we certainly try to benchmark ourselves to all the best practices that they follow. So, it is a learning thing for us.
Got it.
And it's a very good example to follow.
Got it. Well, Mr. Saha, I wanted to iron out a couple of more issues. There's a CCI penalty that was imposed on the company a few years ago. What is the update on that?
So the company is currently in NCLAT with an appeal, and the hearings are yet to be concluded. So really I cannot give a timeline as to when that issue is getting resolved. So we highlight it as a point, in our, wherever we make statements and notes to our accounts, etc.
Okay, all right. And what about, debt was a friend of the earlier promoter, which became a big enemy. Currently our debt is around 365 crores odd. How does that shape up? Do you have a repayment cycle that you all are looking at? And given that you all have various plans, can the debt go up, or has it peaked out around these levels?
I would say debt has peaked up at these levels, and going forward, the management is completely, sworn to reducing it down to a more, I would say, reasonable level. So in the next 2 to 3 years, with the operating cash flows that we have, we believe that it should come down to a very low level of debt.
So the next couple of years, because the debt come down to sub 100 crores with the cash flow?
It would be somewhere around 100 crores.
Okay, all right. Final question before we wind down. There's a lot of focus on electric vehicles, EV. And since you're into batteries, is there any relatability of these two businesses, or are they poles apart and there's no relation to Eveready Industries?
The only commonality is the word battery. Beyond that, it asks for different competencies and skill sets, which we do not have in ourselves, because we do different formats of batteries. These are small cells that goes into, people's small devices.
Well, thanks a lot for that clarification, Mr. Saha. It's been a pleasure speaking to you here on CNBC-TV18.
Thank you, Nigel.
All right, that was a deep dive into Eveready, but time to slip into a short break. We'll come back with another interesting stock. Precision Camshafts is in the spotlight on the other side. Welcome back. You're still tuned into Inside Out on CNBC-TV18. Today's spotlight is on Precision Camshafts, which is a leading camshaft manufacturer. Company supplies all three types camshafts, that is cast iron, ductile iron, hybrid and assembled camshafts. Now, camshaft is a mechanical component of internal combustion engine. The volumes for the company are broken into machine camshafts, which is around 33% of total volumes, and rest is camshafts casting, which is the bigger pie at 67%. Company says they have 9% market share in global camshaft industry and 70% share in India's industry. They have many clients, sharing few names here since it is a long list. The likes of Ford, Toyota, Maruti Suzuki, Escorts, Royal Enfield, Bosch, BMW, to name a few. As on FY23, the capacities of two segments, that is machine casting, stood at 79.2% and camshaft casting stood at 79.8%. They have 8 facilities that include 4 foundries and 4 machine shops as well. Company also has global presence with 2 subsidiaries and 2 step-down subsidiaries and have presence in Netherlands and Germany. Now about the financials. FY21 saw weakness due to weakness in auto industry globally and higher commodity prices as well. From FY21 revenues of around 709 crore rupees, company improved it in FY22 and in FY23 saw decent growth at 1080 crore rupees. EBITDA, however, did not grow in FY23 after some improvement in FY22. After a loss in FY21, company did see a turnaround, but FY23 performance was flat at the bottom line level. They have decent exposure to export markets with 55% revenues coming in from there. The key raw materials used are resin-coated sand, pig iron and MS scrap. So raw material pricing volatility could impact margins. The other risks include one of the Netherlands subsidiary continuously reporting losses, which stood at 14 crores in FY23 versus 19 crore rupees in FY22. And since it is a cyclical business as it caters to automobile sector, demand and hence performance can be impacted. But they are focusing on the EV segment, which could be a high margin business. They plan to set up EV plant at Solapur and also developing an electric powertrain tailored for sub-4-ton LCVs. Promoters hold 65.37% stake with no major holding coming in from institutions. The stock is trading at 38 times one-year forward earnings. But we have run out of time on this edition of Inside Out. It's a goodbye from Nigel and I. But do write to us and tell us the companies you want us to discuss and you want to hear about. And we'll feature these on our show. Thanks a lot for watching.